Right, let's get back to gold. Gold trading once again close to record highs, well north of $3,200 an ounce today. We're joined by David Mcalvany, CEO and Portfolio Manager at Mcalvany Financial Companies. David, thanks very much indeed for joining us. It's hard to imagine a sweeter environment for the gold bugs right now. And I'm thinking in particular the selling in US government bonds last week.
You know, what set this up really nicely is that management teams have decided to not go crazy with mergers and acquisitions. They're not overpaying for assets. They've done a really good job through this last cycle of behaving a little bit more responsibly. You know, in past cycles, they've become themselves gold bugs, and that's been a detriment to the company. So you're seeing record free cash flow from many companies in the space, and investors just turning an eye to the space, which is I think where we see the growth, both for the bullion prices as well as for the miners.
Although, of course, Barrick, which went through its huge merger quite a few years ago, Randgold and Barrick, but Newmont, which has been through major mergers in the last couple of years, their stocks have lagged.
Yeah, they have lagged, and the integration process does take some time. I think the surprising aspect, particularly for Newmont, is the prices paid for the mines that they've been able to, the non-core assets they've been able to dispose of. And, you know, they will, in total, be over $3 billion, maybe even close to $4 billion by the time they've sold off the 6 or 7 assets that they wanted to. So, you know, all-in sustaining costs arguably should come down. I wouldn't expect that until the second half of this year.
And certainly Newmont, I didn't know this, it's up about 40% in the past year. Central bank buying, another factor, of course. Now, you have been looking at what you call the COT positioning and reports, and you say until fairly recently there was extreme interest in gold in terms of speculative activity. That has cooled off a bit?
It has cooled off a bit. We're seeing the commercials and the speculative long positions kind of trimmed back. And so we look at these as sort of contrary indicators. If things are getting really, really aggressive in terms of the positioning, we get a little bit more cautious. And vice versa, as the energy comes out of the space, as marked by the COTs, we would get a little bit more bullish. So here we are sitting near all-time highs, but some of the energy has come out, which is I think healthy for a sustainable uptrend.
But what is your view on gold? When you reckon, I believe, that gold will touch 4,000 next year?
Yeah, I think 4,000 is in the cards. Okay. 2026. We thought 3,250 would be the max that we'd see in 2025. Of course, that was a projection from last year and long before we had sort of the trade issues in play today. So with the trade issues comes a tremendous amount of uncertainty, and financial assets are under pressure, have been under pressure in recent weeks. So the safe haven demand for gold is just beginning to kick in. If central banks are largely responsible for the move in 2023 and 2024, the baton will be passed this year from the central banks to individual investors allocating fresh capital to a space they've left sort of underconsidered and underallocated to for many years.
And you think that really gold, the famous generalist, is at long last coming into gold, a lot of people who had ignored it for years?
Yeah, I mean, you look at the share count for GDX, you look at the diminishment in ounces in GLD throughout 2023 and 2024, and now you're beginning to see it move the opposite direction. Of course, what you needed was a catalyst, and the uncertainty of how we will resolve our engagements globally in terms of trade, that uncertainty is real, obviously impacting the price of oil negatively, but that's you know, on the assumed demand destruction side. What you have with safe haven demand comes at a very interesting time when people are asking questions about the other safe haven treasuries and are looking at it with a little bit more of a raised eyebrow.
Let's get on to oil. You are pessimistic or certainly cautious on oil in the near term, David?
Yeah, and this is, of course, we don't know how these trade tariffs will be sorted out. We don't know if the external revenue If this is something that is really meant to be a new source of revenue for the United States, or if this is just posturing and a way of negotiating with most of our trade partners. So as long as the overhang is there, our base case is 50 to 55
Ooh.
for Brent crude. And, that could very easily pop the other direction as we move towards 2026. A part of the oversupply issue will be resolved pretty quickly if we hang out for a couple of months at these and lower levels, as you're seeing massive pressure already emerge in shale and the Permian.
What do you mean massive pressure to restrain production, or?
Absolutely. I mean, they're not viable below 65. The best numbers I've seen between 60 and 62.50 is what they need to break even. And so, we're now at a point where you can't, as Besant has suggested, increase production by 3 million barrels. You can't do that. You simply don't have the incentive, the economic incentives to expand production at these levels.
Brent at around $65 US today. How low do you think it could go over the next year, David?
I think you have another $10 downside. And as you stretch into 2026, I think that's where our base case improves considerably. And we're back in the 75 to 85 target range for Brent as we move into 2026. I think many of the tariff policies and the retaliatory measures that are weighing on energy, crude in particular, will be in the rearview mirror at that point.
David, thank you. There's some kind of resolution, in other words, of the tariff war.
Absolutely. I mean, this is where we are reconfiguring the global system in intriguing ways. The current establishment has assumed that we need to be on a Cold War footing, and that has to change, or that's the way it has been. And we don't need to subsidize the security apparatus globally. And so we're pulling back, changing the terms of trade more favorably to the United States. And that's certainly the objective of the administration. Of course, we just don't know if they'll be successful in that.
Thank you very much, David. David Mcalvany, CEO and Portfolio Manager at Mcalvany Financial Companies.